Pfizer stock just released their latest quarter's earnings, and so far the market actually seems to like the news. They're up about 3.67% on the day, trading at $23.90. But this does not change the fact that Pfizer is basically trading at a decade low at its current prices. We can see if we look at the past year, they're down about 6.75%, and if we look at them year to date, down by about 10%, with their 52-week low coming in at $20.92 per share. Now, here's the good news, obviously, about the sell-off. If we look at the starting dividend yield for this company, jump over to the dividend breakdown, what we can see is the starting dividend yield for this company is now sitting above 7%. And what's interesting about this is if we look at the historical yield for this company, this is going to be the highest starting dividend yield the company has had in the last 10 years. So similar to how they're at a decade low, the dividend yield is at a decade high. So there's obviously some correlation there. But on top of that, the company has been slowly increasing those dividend payments, which does have something to do with it. The 5-year dividend CAGR, though, is only around 2%. We have to keep in mind, anytime the dividend growth rate is below the rate of inflation, that company technically isn't increasing their dividend payouts. Now, we'll come back and look at these dividend metrics a little bit closer here in just a moment, but let's talk about the recent earnings report. Now, what we can see is the company did beat on bottom lines. Q1 non-GAAP earnings per share of 92 cents was a beat by 24 cents, so a pretty solid beat, but revenue came in at $13.72 billion, which was a miss by about $370 million, and the company's revenue was down around 8% year over year. Now, what I believe investors really seem to like is when the Pfizer CFO stated, "We are currently trending towards the upper end of our adjusted 2025 diluted EPS guidance range." That's obviously good news, but keep in mind, guidance wasn't super bullish in the first place. Now, obviously right now, most people are going to be interested in Pfizer stock for that juicy high starting dividend yield. In fact, if we look at it on a forward-looking basis, the yield is approaching 7.5%. So a 7.5% yield combined with the fact that they attempt to grow that dividend over time, and they've done so for the past decade, that attracts a lot of investors. But you have to look closely under the hood because there are some underlying problems you need to be aware of, specifically with Pfizer stock. As of 2024, the free cash flow payout ratio was sitting at 96.72%. So the company used nearly all of its free cash flow to pay out the dividend. Right here, look in 2024, free cash flow was about $9.8 billion and dividends paid out about $9.5 billion. Even worse, look at 2023. Free cash flow at about $4.8 billion, while dividends paid out was sitting at $9.2 billion. That's obviously not sustainable. Over the long term, in order for the dividend growth to continue, free cash flow is obviously going to need to continue to grow as well. What's also interesting about Pfizer when it comes to capital allocation in general, again, remember, yes, they pay out a large dividend, but they also stated in 2024 they did not complete any share buybacks. And what we can also see is they said in 2025 they don't have any plans for share buybacks. Now, when it comes to capital allocation, we have to remember a company does have 5 options. They can pay out a dividend, they can pay down debt, they can reinvest back into the business, they can buy back shares, and then they can attempt mergers and acquisitions. And properly allocating capital is one of the most important jobs of the management team. And typically most companies we'll see in the S&P 500 will allocate some capital to share buybacks. Now, the reality is share buybacks can be a great way to reward shareholders when done properly. And we can see for a while from 2014 to around 2019, Pfizer was buying back a fair amount of shares. But we have to remember something about share buybacks. They are only effective when a company is buying back its own stock at an undervaluation. If they're buying back its own stock at an overvaluation, it can actually destroy shareholder value. But what's so ironic about buybacks is the fact that many companies fail to do them when it would be most effective. For example, Pfizer is now trading at a decade low with a PE ratio of just 7.8, which is 30% lower than their historic average. Most people would think that means it's a good time to buy back stocks, but the reality is the company simply doesn't have the capital to buy back shares. So how is the company using their capital? Well, we're talking about a pharmaceutical company, and almost always the main 2 priorities for a pharmaceutical company are going to be reinvesting heavily back into the business and potentially pursuing acquisitions. The reason these 2 will typically be the largest is because the future earnings growth of these companies is almost always completely dependent on what is in their pipeline. What future drugs are they going to be releasing into the market? And the pipeline for Pfizer right now is certainly facing some problems. To start, they recently announced some bad news. Pfizer stock dropped after they discontinued their weight loss candidate drug. And this was a drug that had a lot of potential to be a huge growth driver because it was in a market that's absolutely exploding. I believe the weight loss market is projected to grow at about a 30% compounded annual growth rate for the next few years. So how is Pfizer mitigating this? Well, they've stated in recent reports, and this is something they've done over the past few years as well, is they're going to be pursuing more acquisitions to boost their obesity pipeline after the trial setback. So acquisitions are becoming key for Pfizer. And this becomes really clear why when you look at the current pipeline and their current list of drugs. What we can see here to the left is some key drugs currently on the market for Pfizer. And here is when their product patent expires. It's estimated that about 30% of the revenue that Pfizer generates is currently coming from drugs that have patents that are expected to expire in the next few years. So this is a huge risk for Pfizer, and it's certainly why they're taking acquisitions so seriously right now. And so, for example, if we look at the past year or so, Pfizer acquired a company called Seagen, and this acquisition had a total enterprise value of approximately $43 billion. So that's a lot of capital. In fact, if we go ahead and jump over to the balance sheet, let's come up here and plug in Pfizer. To put this acquisition into perspective, what we can see is the company at the end of 2024 was sitting at total current assets of about $50 billion. So compared to the total current assets on their balance sheet, this was a huge acquisition. And what this acquisition did is it greatly expanded the oncology pipeline for Pfizer. The CEO stated, "We believe oncology will be a significant growth driver for Pfizer and contribute meaningfully to the achievement of our near and long-term financial goals." They stated near and long term, but I really think this acquisition was focused on the near term. This acquisition doubled Pfizer's oncology pipeline, now at 59 with 8 blockbuster drugs now expected by 2030. So again, a lot of this is about the near term, and they certainly need it with all those other drugs getting ready to have patent expirations. So let's talk about the valuation for Pfizer for a moment. Again, now on the day, they're up about 4.2%, trading at $24.02 per share. Now, what's interesting is if we jump over to my free cash flow analysis sheet, come up here and plug in Pfizer, what we can see is Pfizer is currently trading with a free cash flow yield of 7.21%. That's higher than their 10-year average, and it's higher than a lot of companies in the S&P 500. Now, what does this mean? Well, it means if you invested $100 into this stock, it would produce about $7.21 in free cash flow based on the trailing 12 months. Now, typically when we buy stocks, we buy them with the expectation that they're going to grow free cash flow, and therefore our free cash flow yield on cost would continue to grow. Yes, they'd produce about $7.21 based off the trailing 12 months, but over the next year, they'd produce even more in free cash flow. But unfortunately, that's not necessarily the expectation for Pfizer right now. In fact, just look at earnings estimates over the next few years based on Seeking Alpha analysts. Earnings in 2025 are expected to actually decline by about 5%. Perhaps we'll see a little bit of growth in 2026, but 27, 28, and 2029 all have negative earnings growth expectations. This is obviously not what we want to see. Now, rarely would a stock that has negative earnings expectations ever be considered a good investment, but there are situations where that could be the case. I mean, for example, short interest for this stock is only 1.72%. So there's still not a lot of institutions actively betting against this stock. So let's go ahead and look at two different valuations. Jump over to my valuation sheet and plug in Pfizer. Let's go ahead and look at our first valuation, which is going to be Graham's valuation, and this is valuing a stock based on its projected earnings and its earnings per share growth. So let's go ahead and get our estimated earnings per share for 2025. Of course, using the ticker data function in Google Sheets, we'll do equals ticker data, select Pfizer. We want the estimated earnings per share average, and then we want it for 2025. I'll hit enter, and you can see the data will automatically load in, and the estimate is 2.94. So we'll come up here and plug in 2.94 and hit enter, and then we need to make a growth rate projection. Now, I'm going to be very generous to Pfizer and go with a growth rate projection of around 2, which obviously a lot of analysts think it'll be lower than that, and I do tend to believe that this is a little more on the aggressive side. But with that being said, after we apply the current yield on AAA corporate bonds, which is quite a bit higher than we typically see it, which will drive down this valuation, we come to an intrinsic value of about $22.01 per share, which obviously is still a little bit lower than the current share price that we're seeing. If we go ahead and look at Pfizer from a dividend discount model perspective, assuming 2% dividend growth moving forward, which keep in mind is in line with the 5-year average, we'd come to a share value of $26.52, which is about 10.5% higher than the current share price. Now again, this completely hinges on whether or not Pfizer can maintain 2% dividend growth. And the past 2 years, they've really struggled to have free cash flow cover that dividend, which is certainly a red flag. So the reality for Pfizer is all these projections that we look at, it's completely dependent on the growth of their pipeline. How successful will these acquisitions, will these new drugs in the pipeline actually be? Because if they flop, then that dividend is at a major risk. With that being said, if we average these two valuations together, we come to a fair value of $24.26, which is actually just 1% off from the current share price. So based on those projections, it really looks like it's trading right at fair value, and with a 10% margin of safety, an acceptable buy price of about $21.84 per share. So yes, there are certainly eye-catching metrics for Pfizer right now. The fact it's at a decade low, short interest is low, and that starting dividend yield looks very high for a company that has historically been growing those dividend payments, but there's definitely some reasons to be concerned about the stock. That free cash flow payout ratio is definitely a red flag. All the patent expirations that are coming up, it's a little bit of a red flag. The company has made it clear that they're making moves and acquisitions to make up for this. So again, the reality is for Pfizer, their success is completely dependent on their pipeline. So yes, this was a decent earnings report, even though they did report a miss on top lines, because they did state they expect 2025 earnings to be on the high end of their estimates, but this is still not a stock I would add to my portfolio. I'm not only looking for good returns, but I'm looking for good returns on a risk-adjusted basis. So I'll continue to watch this stock very closely to see what's going on, but again, it's just going to stay on my watch list for now. Like always, if you'd like to be able to download any of my spreadsheets and get access to the ticker data add-on in Google Sheets that allows you to automatically import stock financials straight into your spreadsheet, then you can head over to tickerdata.com at the link in the description. So with all that being said, thank you guys so much for watching, and please don't forget to like and subscribe to the channel.